it was quite amazing to me. Bond funds also had, for the most part, modest inflows, but they were all down for the year. Most of them were down about 1%. I mean, not a lot, but is there anything in the bond ETF universe, Tom, that you're looking at? John, you could take a crack at this too, but is there any reason for us to look at it? What about high yield? I internally get questions about high yield. People are throwing money still at high yield at 3.5% to 4%. Is that too risky now?
Well, I think this is going to be the big story in 22, Bob. Most don't remember what it's like to invest in fixed income during rising interest rates. It's just not good for a fixed income portfolio. We're surveying advisors all the time that are moving their 60-40 strategies to 70-30s or even 80-20. So what's happening is money is leaving the Barclays Ag core strategy and either doing one of two things: going over to the equity side and looking for dividend strategies, or they're going to real short duration active ETF strategies, or in fact cash. We've got a record $7 trillion in money market funds, $15 trillion sitting in passbook accounts at banks. It's scary because people are concerned about what rising rates do. One final thing, on the other side of the barbell, they're looking at options overlay strategies. We've talked about strategies like Nationwide Newsy or JEPI out by JEPI out by JP Morgan. It's a great way to get added incomes, in some cases 7 or 8%, while you're also have some exposure to equities. And I think we're going to see more of those types of strategies come to the surface.
Yeah, John, apropos of what Tom was saying, Vanguard's short-term bond fund was had some of the biggest inflows this year. It's kind of strange to see a short-term bond fund with enormous inflows, but that goes exactly to what Tom was telling us about. Now, John, last week you launched a new ETF to address these inflation issues we keep talking about. This is the Access ETF that you launched last week. Tell us a little bit about that, the Access Astoria Inflation Sensitive ETF.
Sure. So ticker is PPI. It's kind of a play on the Producer Price Index, which is one of the biggest inflation groups there. Look, Bob, at the end of the day, going back a year and a half ago, I was on CNBC and I said, look, I think rates are rising, inflation's rising. And what we were doing in our portfolios is that we were buying things like banks, industrials, energy, commodities, some of the agricultural plays. And our core portfolio, combined with our sleeve, became a little bit, overwhelming. So we just thought, okay, if we're struggling with this, if we've got 7 ETFs that we're trying to use to cobble together an inflation theme, let's look at a potential ETF that provides, a one-ticker solution that gives you broad market exposure to not only cyclical stocks, which benefit from rising inflation, but also physical commodities, commodity equities, and then tips. So that's what PPI does. It has those 4 segments, cyclicals, commodity equities, commodities, and tips. And I think, again, the narrative is, you said earlier in the show, protect, but we think you should embrace it and then look for strategies that benefit. So the ETF has, the 4 sectors are industrials, energy, materials, and banks. Those sectors historically have had the most sensitivity to rising inflation, and then along with those commodities and tips that I mentioned. So we're excited for it. I think next year will be the theme of inflation ETFs out there.
Yeah, and Tom, what do you think of this here? So what John's got here, 70-80% in cyclical stocks, 10 to 15% commodities, 5 to 10% in tips. I get a lot of questions about tips these days, but I just don't quite get it. I understand it's inflation protected, but it's not going to. It doesn't seem like tips is going to provide you much inflation protection if you really want to try to do a little bit better. I don't know how or what you're advising, but what do you think about tips? I see they're just a very tiny part of John's ETF here.
Well, there's a safety component there, and I think what John and his team has done is great because, first of all, there's a huge void of education on inflation and what it can do to client portfolios. And if you look at commodities in general, up until the last 12 months, it's kind of been an unloved area. So now, by being able to take those areas of the market that do well during times of inflation, I think to what John is saying, it doesn't have to be scary. You can actually lean into it, embrace it, And you can do that by picking off certain sectors in the market and adding it to your portfolio. John's done that with his clients and then said, hey, let's wrap all these areas up into one easy ticker. And then for those that don't have any type of inflation protection, they can buy that one ticker and make it really easy. Hey, I'm a big fan of the traditional fund of funds if it's allocated the right way. Here you've got a manager that's seasoned in spending a lot of time on the markets, and you get it all in one ticker. I think it's great.